Craig, how's it going?
Jordan, good to see you again.
Good to see you again. We're back for the
That
second
same clothes and everything.
Yeah, second installment of the Prevail Pro Tip series, diving into volatility a little bit more.
Yeah.
It's just a very relevant topic right now, obviously. People are opening up their 401ks once they muster up the courage and they glance at the remaining balance in their account, and you have kind of a pit in your stomach, like that first drop on the Mamba roller
Right.
coaster at Worlds of Fun.
That's
So,
right.
I was hoping you could just expand a little bit more on how we can shield ourselves from
Sure.
that in the future. You know, that's going to happen. Everyone wants to have a
Yeah.
401k account.
Yeah.
But what can we do to protect our future a little bit more?
No, you're right. It's obviously a very relevant topic. And volatility is kind of just a natural part of investing, particularly right in equity exposure. And while it is unsettling, it's really not that big of a deal in the accumulation years. In fact, actually, you could argue that it presents opportunities. Some things are on sale. However, in the distribution years, which we're all going to be in at some point, it can be devastating if not managed correctly. So there's this consensus among many financial experts on the 4% rule. And this is a rule that says that if you only withdraw 4% from your account, chances are you'll never run out of money. Well, why 4%? Why is that number? Well, it's because of market volatility, right? It's because the ups and the downs and being able to sustain that volatility through retirement. So you can look historically and you'll see over the market, you'll see anywhere between 2 to 3 down market cycles every 10 years. Now, some are worse than others, of course, right? We're in kind of a little difficult one right now. Everyone seems to focus on average rates of return. But when you withdraw money, when you're in the distribution cycle and you withdraw money in a down cycle, you'll never experience a recovery, right? Because once you've taken that money, you've also experienced that loss.
Right.
The other thing is if you add taxes on top of this, it can be actually a rather large dilution. And I think that's why we're seeing so many individuals that are in the distribution phase being pretty scared and uneasy right now. So for instance, take somebody that's withdrawing out of their retirement account. They've got equity exposure. Their account may be down 20% or more. Now they've got to pay another 20% or more on tax. That just ate up 40% of value of a number that maybe they had at, beginning of the year, January, they're 40% down off of that value. You can't sustain that very long and be in a good spot. So the 4% rule helps to insulate that. But if you're a millionaire, you may have $1 million, and now I can only take 4% out of my account, 40,000. That's not a lot to live off of. So what if you could withdraw 8%, 10%, and still be insulated? What we've found is that by implementing a volatility buffer asset can do just that. Because by eliminating the need to withdraw from accounts in the down market cycle, those 2 to 3 years, and instead withdraw from another account or another asset that has no market exposure, individuals are able to take a much larger percentage of their total assets and actually be a lot more comfortable in the retirement years when we have experiences like what we're having right now.
Okay. It almost sounds a little too good to be true.
Well,
And if this is an extra expense, I just feel like these are things that maybe we can get into in our next segment when we talk about liquidity.
We will get into that on the next segment. That's exactly right. Look forward to it.
Thank you for that breakdown, Craig, and we'll talk to you soon.
See ya.
Bye.